Hello, friends. So today I just want to talk about a taxation policy. And this is announced by Labour government in New Zealand that what's going to be the tax policy next year. So in this video, I'll just analyze the tax policy, what they are talking about it, and what would be the implication of this tax policy. Disclaimer, I'm not supporting any political party that with this party is better or ruling party is better, opposition is better. I'm just looking at the tax policy of them and just add my view into that tax policy. So basically, you might have heard that they have mentioned they're likely to introduce capital gain tax. Now, this is not a new policy. The current Labour government, what they're talking about it, the party, what they're talking about it, the successive people in the party, they have also talked about introduction of capital gain tax, but they never came in power, so they couldn't implement it. And I guess when they came in the power, they just tightened the rules around bright line tax from 2 year to 5 year, then to 10 year, which is currently back to 2 year now. But they haven't introduced capital gain tax because the government back in time got the policy makers in favor of introduction of capital gain tax, but they did not do it. I guess what they're trying to do is they're trying to come into the power, and then they're saying that this should be a policy. So let's talk about the policy itself. What they are saying is we will target residential investment property and commercial investment properties. We will not talk about family home. And whatever revenue we get, we're going to ring fence that revenue with the free GP visits. Let's not discuss the free GP visits because this is out of scope. The scope is tax policy and collection of tax revenue. So if I'm a taxpayer, if I have paid the tax, how the government use it, that's not my criteria. That's not my point to discuss. But let's talk about how much tax they will collect and how they will implement this policy. So they're talking about July 2027. This is assuming they come in the power, then they will do it. July 2027, this is the time they will bring this policy. Now, let's say today if property is worth $1 million and when you sell it in 2030 and it's worth $1.5 million, so there is a 500,000 profit has been made. So they will tax you on that profit. Now, I'm hoping this is what the implication of policy would be. In July 2027, there will be a specific valuation, whether you have to do your private valuation or this will be offered by the government that you can use CV values. So let's say if July 2027, the value is 1.1, so then 1.1 to 1.5. Okay, so which means that if you have bought a property 10 years ago for only 400,000, in July 2027, the value is $1 million. So that has already booked in as a free free tax. There is no tax on that, and anything after July 2027 will be taxed. So this is, I'm hoping this is the policy, because when I was reading it, that's what I could understand from there as well. Now, as you can see, there is a big assumption here, which is a big assumption that property prices will keep rising. Will it not? Hey, from 2021 to 2022, there was a strong growth. But after that, if you see, there is a limited net growth. So if you were the property owner in 2019 to 2026, there is no growth as such, because whatever went up, it's flat. So there's no growth from 19 to 26. The property was worth in 19 is the same as property worth 26 today. So they're hoping that properties will keep going up and up. And if they keep going up, then they're hoping the revenue will come. There's a big assumption here, because I don't know, will it go up the way it has been going up in the past? Currently, debt to income is already very high, 7 to 8. Banks are not lending. So right now we are trading in the currency of townhouses. So there is the new currency for a house, where the house value people can afford between 800 to 900,000. So this is the value of the house that they can afford, and they're trading between those houses. So again, big assumption, house prices will keep going up. According to me, if they want this policy to work, they have to look into comprehensive capital gain tax. By the comprehensive capital gain tax, what I mean is capital gains to be applied on everything, right? Not only investment properties, residential or commercial. Don't talk about only that. What about if I buy a share today? Let's say I buy Tesla for $200 and it's all of a sudden it gone up to $500. I'm making $300 per share, right? I bought 1,000 shares, 1,000 times 300. You can do your maths. How much money I'm making, right? I'm making $300,000. No one talking about it, right? Wouldn't that income be taxed? So there has to be comprehensive capital gain tax to be applied on everything. Why are we only talking about narrower approach to only investment properties? Those days are gone. There is not much money left into investment properties. And by the time we get into taxing those profits, we also need to talk about the losses, because people would be making huge losses as well. Anyone bought a property in June 2021 or 22 the value in July 27 is going to be lower. So purchase price is 1.2, value in July 2027 is 1 million. So it's gone down. By the time they sell, are you going to allow all those losses to be offset against their income? So it's a big question. So according to me, if they want this policy to work, there has to be comprehensive capital gain tax. But at this stage, I'm also with a view that there should not be any new taxes to be added, because the economy is quite a fragile stage, a lot of uncertainty. Any new taxes can put a wrong message in people's head. I get that their policy is we want money to work into different sector of society and we want to move money from investments to businesses. Well, history says New Zealand businesses, people have lost a lot of money in there as well. Financial companies gone bust. Share prices haven't done well, NZX haven't done well in last 5 years. So people haven't got much appetite to take too much risk in this market. What they will do, they will just go elsewhere. They will start shifting money from New Zealand to offshore companies. That's what I'm seeing as my tax advisor. I see day in, day out that a lot of people are investing overseas. So you want money to get out from New Zealand, then money will go overseas. So I don't think if they don't invest into properties, they will invest into New Zealand companies. They might take this money elsewhere in ETFs funds, in managed funds overseas. So that's likely to happen. So if you want to, so key messages, if this policy to be worked, there has to be comprehensive capital gain tax on everything. Don't pick and choose one item or the other, or don't worry about it, because perhaps that's not the right time right now. These are my views. If you like this video, please share with your friends and join me for more videos like this. Thank you.